Welcome to Stocks in Translation. I'm your host, Jared Blickery, joined by the voice of the people, Sydney Freed, along with a very special guest today, Melissa Pigas. She is a serial operator, early-stage investor, and nonprofit board member. And before we begin, we want to make sure that you like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, or wherever you get your podcast. And Melissa, let me tell you what we're going to talk about today. We're going to crack open the world of startups and venture capital, but we're going to keep it simple on entrepreneurial side. And our phrase of the day is venture capital. This episode happens to be brought to you by the number 30. That is a percent of tech startups, the percent of tech startups that pivot their business model in the first 2 years, what it really means to be an entrepreneur. And everyone, this is the story of the week, startups and entrepreneurship. So just tell us a little bit about what you do, Melissa, and what you bring to the table.
Oh, it's great to be with you all today. So I'm an early stage investor, and that means that I am often the earliest institutional investor in a company that might not have a ton of traction and barely has a product. And so we're on this journey in believing that they can build something really big. I chose to do that after almost 2 decades as a startup operator. So on the other side of the table, doing the building of the innovative technologies and approaching new markets. And so I've decided to partner with entrepreneurs on the other side to help them build their endeavors.
All right, and we want to dive right into some words here. Our phrase of the day is venture capital. So this is a form of private equity financing that's provided to startups and small businesses with high growth potential. So you got to have that potential there. Typically involves an investment in exchange for equity or stock, and often includes managerial and technical expertise from investors. So a lot of the famous companies that we know, from applesauce, from Apple to Microsoft to Facebook, these were venture capital-backed firms, and you're also in the game, but you're an early-stage investor, not necessarily venture capital. Tell us about that side.
So I'm typically looking to invest in companies at their seed and pre-seed stages, so that is the earliest stages at which they're accepting outside capital. So at the very earliest stages of venture capital, typically you have founders that are self-funding their companies, then they have their friends and family that are supporting them emotionally in that journey and also with cash. And then you've got investors who are willing to take bets very early on where it's riskiest, because we believe that we have the ability to help founders building in a very specific domain. So that's a little bit about what I do. I'm specifically looking for startups that are building in commerce technology, which is broad by design. That includes fintech, marketing technology, supply chain technology. I think of it as the entire ecosystem of technology that helps to facilitate the trade of goods and services between people and businesses.
How did you go into that niche of commerce
And
technology?
how early are we talking about?
Yeah, absolutely. So I decided to get into that niche because that's just what I know best from being a startup operator. So as a startup operator, I worked in the commerce technology space, was part of the early stage teams for 9 startups, and ended up exiting with all 9 of them. And
Congratulations.
Thank you.
Yes.
Decided that I wanted to take the term from investing my time to investing capital. So I wanted to invest in the areas that I know best, being commerce technology, and by extension, consumer technology. And then we can't talk about commerce technology without talking about climate tech.
Okay.
A lot of the conversation around sustainability and the fact that it's not only good for the planet, but it's great for businesses as well. And the newest offshoot of commerce technology being creator economy technologies. How do we empower individuals to create productive revenue streams for themselves? So that's a little bit of the types of startups that I'm looking for, and partnering with them at the earliest stages to really help them with 2 things: how they effectively sell their products or services into markets at scale, and how they prepare to go on to tell their story and raise subsequent funding from other investors.
Tell us about that process. Okay, you're an early company. How long do you work before you have to go to the market, tap the capital markets? We talk about series funding. You get A series, you get B series, C, can go all the way up to D and further. But what's the timeline here?
So typically, founders are raising it used to be 12 to 18 months of runway to get them between rounds. Now that's a little closer to between 18 to 24 months of runway they're looking for. And that's effectively how much money they need to pay employees and keep the lights on and keep building. And the idea is that in that period of time, they should have achieved sort of the milestones. And there are some generally accepted milestones that your company should hit, largely in terms of revenue before you go out to raise your next round
Like
from
any
investors.
big round numbers there?
Exactly. So for pre-seed, you're looking for around $250,000 in annual recurring revenue. For your Series A, it's $1 million in annual recurring revenue. And based on the market, those numbers might be higher or lower. Depending on the industry you're building in, they might be higher or lower. And so typically, companies are working on hitting those milestones and preparing to go out and tell that story of, we had this great momentum. Here's all the traction we've gotten with this extra funding. And now we're back out in the market to raise more funding to go a little further.
So when you said you had 9 startups and you exited with all of them, is the word exit referring to each stage of funding? You exit each one, or is it something at the very end?
Leave the entire business.
Yeah. So when I talk about all of the 9 early stage companies that I worked with exiting, meaning that they sold their business. So there was a formal transfer in ownership of the business. And very often when companies think of exits, the most common that we talk about in the world of venture capital is when you go public, you access the public markets. Some other common exit paths that we see are through corporate acquisition. So larger companies are buying startups. Typically, the most ideal time for a startup to sell is right before their Series A. The universe of candidate buyers is largest for them. They can also decide to buy out their investors and keep their company private and profitable. There are lots of different exit paths, but in this specific scenario, I'm talking about where they sold the business.
Do you have to sell? What happens if you don't want to go public?
Yeah, I
and you
mean,
don't
Mark
sell?
Zuckerberg, a founder, he's still in control.
That's such a great question. I always tell founders that there's one essential truth if you are going to embark on this journey of venture capital and accepting venture capital. When you accept money from an outside investor, you're accepting that it means that it's no longer your business, and at some point there will be a liquidity event. You will sell the business because the investor is investing that money for a return. So there needs to be some liquidity event for them to see the return on their investment. And I think that's a really important concept for founders. It's really difficult when you think about what are all the different resources I can leverage to grow my business, but it's also really important to consider, what does this mean for the future of my business and for the options in terms of how I lead? What are the strings attached?
What is it like? Tell us what it's like to be a female operator in this field.
I think it's just like being an operator. Being an operator is really hard. There's a lot of fundamentals around how you think about growing your go-to-market, how you think about hiring and building great teams, always listening to your customer and keeping an eye to the market. Those are essential things that seem simple and easy to do on the face, but as your business grows in size and scale and complexity, your priorities are often competing. And so it's really easy to lose sight of that. But I would say as an operator, it's really always understanding that at the end of the day, you answer to the customer. And as a great operator, your job is to hire wonderful people that are just as passionate about the mission and serving your customer as you are.
You told us like kind of what field you work in, but what are the characteristics of those specific companies that you look for?
So if I take the industry focus away, and that's important because I want to make sure that I'm investing in companies where I can help. So I know something about the market, know something about the product. But outside of that, we're looking for momentum in traction. So is this a company not only where there's great demand for the product, but we see it's growing really quickly? Typically, when we're looking at wonderful deals, we want to see, does the company have the opportunity to grow to around $100 million in sales in 5 to 6 years? That's general rule of thumb for what makes for a great venture scale company. So around that traction and the momentum and traction, but also market, is it a really big market and growing market? But at the earliest stages, truly, there's so many different ways to slice and dice a business. But at the stage where I invest, there's often not much more to the startup than the team. They don't have a ton of customers. They don't have a ton of revenue. The product is probably in beta. So you're really taking a bet on the team and you're asking yourself, is this the best group of people I could find to be working together to solve this problem? And if yes, then how do I help them become unblocked by other obstacles that my pop up along their journey, but ultimately really supporting them.
That's really personality based.
That's a lot less tech and a lot more personal. So that's kind of surprising. We had a really big Fed decision last week. So I'm going to pivot here to interest rates. The cost of money, and it's going down. How does that affect you? Like, we've seen the most rapid increase in interest rates since the early 1980s. I know that killed off a lot of liquidity in the market, but tell us about that from your perspective.
It's really interesting. I had this moment where I too was asking myself what this meant for the market, what this means for founders who are out in the markets fundraising right now. And if we look back a few years to when interest rates were low, it was easy to raise, and it was easy to raise at high valuations. And so do I think that we're going to see a lot more of that ease and liquidity coming back into the market? I hope so. But I also think investors are going to be asking a lot more questions around sort of the fundamentals of the business.
So that would be good.
Exactly, to make sure that valuations are in line with sort of market conditions and market expectations, and ultimately that we're setting up the founders for success when they think about their ability to continue to grow and lead the business. So I'm not sure what it means, but I definitely hope it's a positive signal. I think it's a positive signal.
Looking at the fundamentals, like, do you think that's going to be good or bad for certain sectors or industries?
Overall, I think that's going to be great for early stage. Some of the things that we saw over the last few quarters was that bar for growth for milestones that startups needed to hit. Those sort of milestones, that bar getting a bit higher. And
just because there was less capital to go around?
Because there was less capital. And so necessarily, I think we were being more scrutinous of companies that were sort of coming across our plates. And in any sort of market, there are the industries that are hottest and are going to get the most attention from investors. I think this is going to be really good probably for AI startups right now. But in general—
let's talk about AI in a bit.
Yeah, but in general, I hope for everyone that means that people are able to successfully and quickly raise rounds so they can get back to building. That's always our hope for all founders.
Pause that right here. We got to take a very short break. But coming up, we're going to talk about a tough process every founder probably goes through at one time or another, the pivot. And we pit the mythological unicorn against the mighty zebra on today's Who Wore It Better. And we're back. This episode is brought to you by the number 30. That is a percent of tech startups that pivot their business model in the first 2 years. And that's just an average. But it raises an issue you might have faced personally, Melissa. Like, you have your business, you're on the ground here, and you realize things aren't going your way necessarily, and you got to move in another direction. How do you decide that?
The best founders are always asking themselves, how is the market evolving? How do my customers' how are their sort of needs and preferences evolving? How is the market overall evolving? And pivoting is just a fact of life for, I wouldn't say for most startups. And the ability to pivot quickly can mean the difference between growth and sort of the end of a journey for a startup as well.
So growth and death.
Exactly, which is really interesting. And so I think it's just a function of being a quickly growing business. You're always sort of learning. There's sort of new facts coming to light, new things that you're learning about your customers as you're entering new markets, as you've been working with them for a longer period of time. And the business has to necessarily respond to those changes. So I think we'd be hard pressed to find a successful company that hasn't had a few pivots.
Well, and speaking of pivoting, is a reason to pivot maybe that you keep, like, what happens if you fail to raise money at different stages? Is that a reason when you have to say, like, oh, well, I have to make a change in my business plan? Is that true?
I think that's absolutely true. We put together a business plan, and we have a bunch of assumptions around how the business is going to grow and what is required to achieve that level of growth. And so this is something I talk to founders about all the time when they think about fundraising in general. And they say, well, how much should I raise? I said, well, the right question is actually, what can you do with different levels of funding? And the same thing happens as companies can potentially struggle to raise. Then they need to look and say, okay, growth was the initial goal, but default alive is pretty good. We want to focus on staying default alive. And so one of the things that we saw happen, especially over the last, I would say 1 to 2 years, was looking at seeing companies who were opting for profitability or maybe adding services onto their offering to make sure that they could stay default alive and cover their expenses while fundraising markets maybe weren't as open and viable.
Profitability, yes. What are the keys to a successful fundraise?
Keys to a successful fundraise. I wish it was formulaic. It's not. It's large.
Otherwise, everybody would be doing it.
Yeah.
Exactly. First and foremost, it's largely a function of your network. There are a few things that founders need to be successful. First is access to capital, access to customers, which helps them with profitability, but it's ultimately that access to community that gives them the things like the employees that they ultimately end up hiring, the investors that end up joining them on the journey for their business, and early beta customers who support them. So it's first that connectivity and for founders thinking about how they're building their network before they need it. So a good example is that this is the kickoff of Climate Week in New York. And if I was a climate tech founder, even if I wasn't necessarily raising, I'd probably be in town and be out and about and asking myself, what are the right connections and networks that I want to be part of as I'm thinking about what my business will need over time?
Yeah, you got to schmooze. You got to play the game a little bit.
Yes.
Going back to AI, are AI startups all the rage right now?
Yes.
How many are there? Are they unlimited? Is everyone just like throwing out ideas around AI?
Like, is a lot of liquidity going to AI? Are they starving the rest of the market of capital?
I wouldn't say that they're starving the rest of the market of capital, but I do think that AI has been a bright spot in the market. It's interesting. Everyone's trying to figure out how it's creating new industries, how it's going to accelerate some existing industries. So I would say there's not an investor or an industry that's being untouched by AI right now. But there's another really interesting part of that question where you ask sort of how many there are. And one of the most interesting promises of AI is, I think, the reduced sort of barrier to entrepreneurship and to launching your startup that it's going to provide for people all over the world.
It reduces barriers to entry for everything.
Exactly.
Yeah.
It's never been easier, quicker, cheaper to start a business, and AI is only going to continue to accelerate that.
But does that mean there could also be a lot of failures theoretically? Because
Well, there should be, right?
yeah, I guess. But you also don't want to see like everyone's just throwing their hat in the ring using AI to do whatever, putting AI in their name just because they think they'll be
did that on
successful.
Twitter.
Exactly. And then like it turns out, oh, your business model is not that great. You just kind of wanted AI in there. Does that sound right?
I think with a higher volume of startups, there likely would be a higher volume of failures. But the good news is that it doesn't cost as much to fail fast anymore. So you can have a great idea and you can test and iterate and figure out if there's a there in the market quicker and cheaper than ever before. So probably we'll see some companies try to make it big. And I think it's also going to mean that there's a lot of different journeys and outcomes for a company. So it won't just be growing a really big company and hoping to access the public markets, but AI is also going to mean that companies are able to operate more leanly than ever before. So maybe some will opt to not raise venture. Maybe some will opt to raise only one round and not have to raise anymore. It's definitely going to change the dynamics of doing business.
But what happens if you don't raise money?
Well, the idea is that, if your business becomes cheaper and easier to operate and you're no longer paying a premium for customer acquisition, there's a world in which we might have one-round startups that only raise one round of financing before they decide to exit or go out and try to access public markets. And
That's impressive.
Yeah, so I think it's going to be really interesting. We're going to see some cool things happen in the next 5 years.
I agree with that. Maybe even sooner. All right. On today's Who Wore It Better, we are pitting the mythological unicorn versus the mighty striped zebra. Now, for listeners, unicorn startups, they focus on rapid growth and reaching $1 billion valuations, often backed by venture capital, aiming to dominate markets. So get big fast and just dominate. In contrast, zebra startups, and I had to look this up, this is a new term for me, prioritize steady, sustainable growth, balancing profit with social impact, and often use alternative funding. And you were introduced to this term. What does this mean to you?
So this is a new term to me, but I actually really love it. And I think it's a great way of categorizing those companies that I've always previously described it and said that it doesn't have to be a choice between doing good and doing well. And so to me, that sounds like what a zebra is. They're both doing really well from a business perspective as well as having a ton of impact. It also reminds me of the premise of, for example, employee-owned businesses like a Bob's Red Mill we were talking about as an example. And they're definitely different types of businesses are in vogue during different phases of the market. But as you describe what a zebra is and its focus on sustainability and community impact, that sounds really exciting. I hope that we see a few more zebras.
Yeah,
Well, the idea is good, but I guess my question is if it's slow, if it's steady and sustainable, those sound like good words, but is it slow?
Is it practical?
Is it too slow?
Oh.
Is it practical?
I think it's very practical. We have to remember that the idea of a venture scale business and the trajectory of a venture scale business is a very new phenomenon. When we think about a Zebra, I
80s?
think about our typical Main Street businesses, small businesses all over the country, and ones that had to think about how they grew through profitability, how they grew at a steady and sustainable pace before venture capital emerged as an asset class. So I think it's probably maybe a little bit of the getting back to basics.
Really interesting. We want to get a little bit personal, and you are on the board of Music Heals International, MHI. Tell us a little bit about this.
Yeah, so Music Heals International, we're a nonprofit organization where our goal is to provide free music education to children all over the world.
Phenomenal.
We currently operate in Haiti, in Venezuela, and in India. And the idea is that exposure to music education at an early age, it really helps reinforce some core principles around creativity and resilience and teamwork, things that ultimately serve you really well as you develop into an adult and you think about sort of the different outcomes that you want for yourself in life. One of the really exciting things about our music programming as well is that we've been operating since around 2010. And so now we're at a place where students who were part of our earliest programs are now returning as instructors.
That's
and
amazing.
So we've been able to really create this learning to earning pathway for them all through the lens of the arts. And that's really exciting. So I'm really proud of our activities and excited to see it expand.
And this comes, you have a personal history with music here. Can you tell us about that?
I do. So I had the privilege to learn how to play an instrument at a very young age. So I learned
Which instrument?
the viola.
Oh,
Very nice.
I learned how to play the viola. I played it for many, many years. And then when I graduated from university, my mom gave me this beautiful violin. And I was like, thank you. This is beautiful. I do not play this instrument. And she was sort of like,
Interesting.
Oh no!
I got it at an antique shop. It was very nice. You now will learn how to play the violin. So that was a process of learning a new instrument and learning how to read sheet music from scratch all over again. So.
Wow.
Well, Music Heals International sounds like a fantastic organization. Speaking of teaching children, do you have an interest in teaching younger folks about startup culture?
Absolutely. I am really passionate about expanding access to entrepreneurship to young people, to people all over the world. I'm actually on the board of another nonprofit organization called Entrepreneurs Across Borders. And what we're doing is helping communities really embrace and kick off that sort of flywheel of micro entrepreneurship. And that can have a tremendous, not only up-leveling effect on the individual, but also incredible impact on their communities as well.
That's great. I feel like we don't learn enough about some of these things in school. So you kind of have to get some of this stuff elsewhere. So you're on 2 boards. How does one get on a board?
And do you want to be on more?
Yes.
So I think serving on boards, it's an honor, it's a privilege, it's really exciting to be able to have that role in the governance and strategic outlook of an organization that you're really passionate about. I find one of the best ways to find board opportunities is just to let people know that you're open to them. A lot of people are looking to fill board seats probably more than you realize. And I think starting with organizations that you're really passionate about. So there's a big responsibility in being on boards that you're going to make the time and be committed to advancing the causes. So it's something that you've got to do actively. I'm definitely excited about the opportunity to join the boards of more organizations that I'm passionate about, but also keeping that volume reasonable so I continue to make an impact.
Not 20, maybe 3, 4.
Maybe 3 or 4.
I want everyone to know I'm not downplaying the time and energy it takes, but I'm open to be on a board.
All right,
know?
Sydney, the voice of the people. Come on, you need the voice of the people here.
Get me in there. Get me in there.
Yeah.
All right, we're winding things down here. We got to go. But we want to make sure you check out other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We are also on all of your favorite podcast platforms, YouTube, Apple, Spotify, iHeartRadio, Podtail, Pod Paradise, and more. That is all for now. Keep your dial tuned to Yahoo Finance.